All right, let's talk about KEI Industries. This company has pulled off a really massive strategic transformation, placing itself right at the heart of India's energy transition. So what we're going to do in this explainer is break down the bull case, the argument for its explosive growth, and then we'll flip the coin and look at the bear case, digging into the very real risks that are on the horizon.
So at its core, KEI has fundamentally changed its DNA. The company has successfully shifted from being a pretty traditional industrial B2B kind of manufacturer to becoming a high-margin, consumer-focused brand. And really, this move couldn't be timed any better to ride the huge wave of electrifying India's infrastructure. A huge part of KEI's strategy was about de-risking the business. And how'd they do it? Well, they made a deliberate move away from those really cash-intensive EPC projects. Instead, they built this robust network of over 2,100 dealers, and believe it or not, they hit a 55% B2C sales mix. This shift is a big deal. It means a much healthier and more predictable flow of cash.
Okay, to really get a grip on this whole bull versus bear debate, we've got to look at the journey that got them here. This next part is all about the history and the huge macro trends that are pushing KEI's business forward.
So let's trace it back. Starting in fiscal year 21, the company really began its pivot. By 24, they had absolutely cemented their leadership in that very specialized extra high voltage cable market. Then, fiscal 25 was a year of major investment. We're talking 1,300 crores in capex for the new Sanand project. And all this hard work paid off. By March 2026, the stock hit an all-time high, which shows some incredible technical strength.
Now, you've got to understand there is this massive tailwind behind the company, driven by some serious long-term demand. For one, India has a national target of 500 gigawatts of renewable energy, and on top of that, the EV transition is picking up speed like crazy. Now here's the kicker. EV infrastructure needs 3 times the copper of a traditional grid. That creates a steady, sustained demand for exactly what KEI makes.
Okay, so let's get into the bull case. The whole optimistic outlook really comes down to 3 core strategic pillars.
Pillar number 1, they're the leader in a really tough market. The 400 kilovolt extra high voltage cable segment, well, it's a technical niche with super high barriers to entry. KEI is one of the very few domestic players that can even do this, and demand is absolutely surging from power-hungry data centers and all the new green energy corridors being built across the country.
The second pillar is all about global ambition. In the third quarter of fiscal 26, KEI's global exports jumped, get this, an incredible 95% year over year. This just proves that their quality is now globally competitive. It lets them chase higher margins in international markets, and, it protects the business from any potential slowdowns back home.
And pillar number 3 is the Sanand facility. Think of this as the engine for all their future growth. Once it's fully up and running, this project is expected to unlock an additional 6,000 crores in annual revenue. This brand new capacity is what's really backing up management's guidance for a steady 20% plus growth rate.
And what's backing all of this up? Well, it's a rock-solid financial foundation. I mean, check this out. As of December 2025, KEI is sitting on a net cash balance sheet of 1,267 crores. That's a huge financial moat. It gives them a massive cushion against any bumps in the road. And, more importantly, it means they can fund their own future growth, their next big capital projects, without having to go out and borrow money. That is a powerful position to be in.
All right, now let's flip the script and look at the counter-arguments. The bear case really zeroes in on 2 major hurdles: valuation and execution. The stock is trading at a price-to-earnings ratio of 54 times, which is way above its historical average. So the bears are basically arguing that the stock is priced for absolute perfection. Any little misstep, like say the current 6 to 8 month delays they're seeing at the Sanand project, could trigger immediate earnings downgrades. And the other major risk? Competition. It's fierce out there. While KE is growing strong, its main rival, Polycab, saw its revenue grow by a staggering 46% in the last quarter. This brings up a really critical question. Is KE actually losing relative market share in the bigger electrical space, even though it's a star in its specific cable niches? So, how do we bring these 2 totally conflicting views together? Let's try to wrap this up by looking at both sides and then seeing what management itself has laid out as their clear path forward.
Right, so this is basically management's promise to the market. They're targeting a sustained 20% growth rate, and they want to push that B2C share up to a dominant 60%. The central challenge here is pretty obvious. Can the leadership team execute flawlessly on these super ambitious targets to justify that premium stock valuation?
And that really leaves us with the big question, doesn't it? Is KE's premium valuation a fair price to pay for its brilliant strategic execution and market position? Or do the risks, the intense competition and those project delays, present a hurdle that's just too high? That's the debate that the market is going to have to settle.